Taxation introduction. Taxation has been a function of sovereign states since ancient times. We always assume that India has adopted the taxation system from the British. However, the tax system existed even during the Chola period in ancient times. Only value-added tax and fringe benefits tax were not in existence in those days. Some important taxes of the South India of those days included Kadame, land revenue, paid to the king. Kudame is the obligation of the tenant, general term denoting all taxes except land revenue, Ireor and Therium, cash levy on tenants. Some Pallava taxes were as follows: 1. Salt tax. 2. No concrete evidence of land tax, but private ownership of land was allowed. 3. Tax on professional toddy tappers. Different rates on fresh toddy and sweet toddy. 4. Tax on cattle breeders. 5. Professional taxes on barbers, washermen, professional as well as for the state tank, water and stone, goldsmiths, blacksmiths, potters, village weaver, on ton, profession etc., brokers, terrakas, oilmongers, etc. 6. Brahmanasakanam, tax payable by the Brahmin priests to the kings. 7. Taxes on animals owned, trees, wells, etc. These Pallava and early Chola taxes were called Vain, Ayam, Kanam, Dandam, Korai Kadame etc. After the mutiny of 1857, the British government faced an acute financial crisis. To fill the treasury, the first Income Tax Act was introduced in February 1860 by Sir James Wilson, British India's first finance minister. The act received the assent of the Governor-General on the 24th of July 1860, and came into effect immediately. It was divided into 21 parts, with 259 sections. Income was classified in 4 schedules. I. Income from landed property. Agricultural income was taxable. II. Income from professions and trade. III. Income from securities, annuities and dividends. And IV. Income from salaries and pensions. A number of laws were enacted to streamline the income tax laws. The Super Rich Tax and the New Income Tax Act were passed in 1918. The Direct Taxes Administration Enquiry Committee, under the chairmanship of Mahavir Tyagi, submitted its report on the 30th of November 1959, and its recommendations took shape in the Income Tax Act, 1961. The Act, which became effective on the 1st of April 1962, replaced the Indian Income Tax Act, 1922. Current income tax law is governed by the 1961 Act, which has 298 sections and 4 schedules. The Direct Taxes Code Bill was sponsored in Parliament on the 30th of August 2010 by the Finance Minister to replace the Income Tax Act, 1961 and the Wealth Tax Act. The bill could not pass, however, and lapsed after revocation of the Wealth Tax Act in 2015. About Income Tax Department. The Income Tax Department, also referred to as IT Department, abbreviated as ITD, is a government agency undertaking direct tax collection of the Government of India. It functions under the Department of Revenue of the Ministry of Finance. The Income Tax Department is headed by the apex body Central Board of Direct Taxes, CBDT. The main responsibility of the Income Tax Department is to enforce various direct tax laws, most important among these being the Income Tax Act, 1961, to collect revenue for the Government of India. It also enforces other economic laws such as the Benami Transactions Prohibition Act, 1988. Power to levy taxes. The Constitution of India, in Article 265, lays down that no tax shall be levied or collected except by authority of law. The Parliament and state legislatures are empowered to make laws on the matters enumerated in the 7th schedule by virtue of Article 246 of the Constitution of India. 7th Schedule to Article 246 contains 3 lists which enumerate the matters under which the Parliament and the state legislatures have the authority to make laws for the purpose of levy of taxes. The following are the lists. I. Union List. Parliament has the exclusive power to make laws on the matters contained in Union List. II. State List. The legislatures of any state has the exclusive power to make laws on the matters contained in the state list, III, concurrent list. Both Parliament and state legislatures have the power to make laws on the matters contained in the concurrent list. Taxes are levied by the governments to meet the common welfare expenditure of the society. There are two types of taxes, direct taxes and indirect taxes. Direct taxes: if tax is levied directly on the income or wealth of a person, then it is a direct tax. The burden of a direct tax cannot be shifted. They are classified into two types. They are 1. Income tax. An income tax is a tax imposed on individuals or entities, taxpayers, in respect of the income or profits earned by them, commonly called taxable income. Income tax generally is computed as the product of a tax rate times the taxable income. Taxation rates may vary by type or characteristics of the taxpayer and the type of income too. Black, grey money, undisclosed foreign income and assets, and Imposition of Tax Act, 2015. It aims to curb black money, or undisclosed foreign assets and income, and imposes tax and penalty on such income. The Act has been passed by both the houses of the Parliament. The Act has received the assent of the President of India on the 26th of May 2015. It came into effect from the 1st of July 2015. The taxpayer holding undisclosed foreign income and assets is liable to pay a penalty which is 3 times the tax computed under Section 10 of the article. If a person provides inaccurate information or does not provide information in general, is subject to penalty of 10 lakhs Indian rupees. If the taxpayer is in default, he/she is liable to pay a penalty which equals amount of tax arrears. Indirect taxes: if tax is levied on the price of a good or service, then it is an indirect tax. In the case of indirect taxes, the person paying the tax passes on the incidence to another person. They are classified into two types. They are 1. Goods and Services Tax, GST. GST is a digitalized form of VAT where you can also track the goods and services. Both VAT and GST have the same taxation slabs. Goods and services are divided into 5 different tax slabs for collection of tax: 0%, 5%, 12%, 18% and 28%. The GST was launched at midnight on the 1st of July 2017 by the President of India and the Government of India. It replaced existing multiple taxes levied by the central and state governments. The single GST subsumed several taxes and levies, which included central excise duty, services tax, additional customs duty, surcharges, state-level value-added tax and octroi. Other levies which were applicable on interstate transportation of goods have also been done away with in GST regime. GST is levied on all transactions such as sale, transfer, purchase, barter, lease, or import of goods or services. India adopted a dual GST model, meaning that taxation is administered by both the union and state governments. Transactions made within a single state are levied with central GST, CGST, by the central government, and state GST, SGST, by the state governments. For interstate transactions and imported goods or services, an integrated GST, IGST, is levied by the central government too. Custom duty. Custom duty is a kind of an indirect tax that is imposed on both exported and imported goods and services. The tax imposed on the import of goods is known as the import duty, whereas the tax imposed on the export of goods is known as the export duty. The government charges these taxes during the export or import of goods and services to raise money and or to shield the domestic establishments from the competitors from other countries. The custom duty is now replaced by IGST, which means that instead of the custom duty, IGST tax is applicable, along with other applicable custom duties, on every import and export of goods and services. Before IGST was enforced, custom duty was levied on all export and import of goods and services. Also, innumerable taxes such as countervailing duty, CVD, basic custom duty, Anti-dumping duty and safeguard duty were imposed on every import of goods and services. When GST came, it shook the entire tax system by holding all indirect taxes such as central excise duty, service charges, state-level tax, and introduced a single tax known as IGST, Integrated Goods and Services Tax. Conclusion: taxes are the largest source of income for the government. This money is deployed for various purposes and projects for the development of the nation. Taxation has been the primary source of revenue for states across the world for centuries, and India is no exception to this. The Indian tax system is well structured and has a three-tier federal structure. This has consequently led to India's meteoric rise to the top 100 in the World Bank's Ease of Doing Business (ERB) ranking in 2019, as India jumped 79 positions from 142nd, 2014, to 63rd, 2019, in World Bank's Ease of Doing Business ranking 2020 feet. The current tax-to-GDP ratio is estimated at 11.1%. The reason for levy of taxes is that they constitute the basic source of revenue to the government. Revenue so raised is utilized for meeting the expenses of government like defense, provision of education, health care, infrastructure facilities like roads,